In this week's update, the COVID scare is back. But was this an overreaction, or is it the start of something bigger? And preparing for excellent opportunities. My name's Garry Davis, and as always, this is general advice. And please remember to like and subscribe to the video. All right, never a dull moment. Just when things were seemingly coming together, COVID vaccination rates around the world were hitting targets, and it looked like we were perhaps preparing for the run into the end of the year. And now we've got this new variant of the COVID virus, and who knows where it's going to lead. There are three ways that this can go. Friday was a big overreaction in global markets, and there was quite a strong sell-off. So that's the first one. And frankly, I don't have an opinion. I don't know which one of these three alternatives will predominate, and no one else on the planet does either. So let's be clear about that. But it's just worth evaluating the possibilities to put it in perspective. So if Friday was a big overreaction, then markets will settle pretty quickly. And I still think, though, that we'll see a fairly large bifurcation at the sector level. In other words, some sectors doing far, far better than others. And we saw on Friday the sell-off was concentrated in all the obvious areas related to travel and lockdowns and retail spending and all those sort of things. So there weren't any real surprises. And it was very similar to what we saw in February, March of 2020. The second way that it can go is that the new variant causes uncertainty for long enough to be a problem, and markets hate uncertainty. And in that case, we may see a progressive correction, something in the order of 10 or 20%, which frankly is not that big a deal because we are overdue for something of that nature, and it would actually be quite healthy. The third way that it can go is that the new variant becomes a big problem. You know, it just ignores all the current vaccines, and it's a matter of going back to square one. And science has no idea if that's going to be the case. If that were to be the way that it played out, however, then market disruption is going to be a lot larger, and there could be a repeat of March 2020. Now, at this point in time, you'd have to say that that is a low, very low probability. But let's keep it on the table that it's possible, and perhaps that can guide our thinking and our actions. So no one can possibly know how this is going to unfold, but there are some things that we do know. We are far better prepared now than we were at the start of 2020. We know far more. We're ready for it. The market is not going to be caught off guard. I mean, that was one of the major problems in February and March of 2020, that all of a sudden the market was just stunned by something that we'd never seen before, which was the necessity for global lockdowns and basically, stop the global economy in its tracks. Never had that before. So the market was caught very much off guard. This time, we're not. It's not going to be nearly the surprise, and therefore I think it's logical to conclude that the response in the market this time is probably not going to be anything like what we saw last year. However, there will still be potentially some significant impacts and some areas of the market that you do not want to be in. So it's important to analyse what we can learn from March 2020, because at least as far as last Friday went, the market reaction was very similar in terms of the best and the worst to what it was in March of 2020. Energy was the worst back then, and it was the worst on Friday because of perceptions about demand for oil. Consumer staples did well. Healthcare did fairly well. They were sectors that did the least bad back in 2020, and the same thing occurred on Friday night. So we need to have a look at what we can learn from March 2020. But the lesson, and I'll certainly be doing that for members over coming weeks. But the lessons that we can take from that is that even as bad as it was last year, and the selling was incredibly extreme, with the S&P down about 36%, and the mid-cap section of the US market down about 43 or 44%, it only lasted 1 month. Now, I know it was horrible at the time, but it's only 1 month. You know, if you'd been on holidays for a month and not turned the news on, you wouldn't have been aware of what was happening. So that was the first thing, that it was a health issue. It wasn't a financial issue. The other lesson we can learn is that there was an incredible diversity in performance. The stocks that were most impacted by the lockdowns did very, very badly. But there were numerous stocks, like Zoom, for instance, a lot of the work from home stocks, that did unbelievably well. And technology stocks, whilst they did get hit initially, they bounced back very quickly, and there was some fantastic results in tech stocks. So it did lead to a huge diversity in performance. And if what we saw on Friday has any legs, then we're going to see exactly the same thing again. So rather than getting concerned about what happened on Friday, you need to get pretty excited about what possibilities this might throw up. Now, we don't know what the ground will be between now and 1 month's time, but you've got to expect that there's going to be really good opportunities. And in 2020, some of the best opportunities that I've ever seen arose and became very obvious. You know, to buy into stocks like Microsoft and Amazon and Google were just absolute no-brainers after that 1 month of absolute smashing. And if we do get a significant market reaction, then a similar thing will happen again, and you need to be prepared for it. So this is what you need to do, in my opinion. You need to be very clear on what your position of comfort is. And for different investors and traders, that means very different things. So there is no one-size-fits-all here. You've just got to look internally and ask yourself how comfortable you're going to be if the market goes down 5%, 10%, 20, 30, and then ask yourself what you should do about it. But waiting to see how it unfolds and playing it by ear, I can assure you, is not the way to go. You can actually think about this now. Think about how comfortable you would be if the market did fall 10 or 20%, and you can make decisions now. Now, if it doesn't turn out that we do get a correction, well, there's no real harm done. You've just pulled out of the market, pulled part of your money out of the market temporarily, and you can always get back in again. You know, it's no big deal. It's better to do that than if you're a nervous kind of investor that's not very resilient to the downside, staying in there and hoping it's all good, because if the market does fall 10 or 20%, then I can almost assure you that what you're going to do is sell somewhere near the bottom, because the pressure will just get so great. So you're better off making the decision now. So be very clear about what your position, your personal position of comfort is. The second thing to do, quite obviously, it's hard to do, but you've got to try and switch off, is just ignore the headlines, because they're just going to mislead you. They're not going to be at all helpful. They weren't in 2020. In fact, they were outright damaging, and they're not going to help you this time either. The third thing is to reduce exposures to the worst performers of March 2020. And it's pretty obvious what they are. You just need to sit down and think about what companies and stocks get most affected by lockdowns and by an economic slowdown. And it's obviously, it's airlines and it's travel and it's parts of the retail market, et cetera, et cetera. And I'll be covering this in far more detail with members during the week. And the next thing to do is to prepare your list of buy targets. Again, don't just wait until it feels like the coast is clear and then you start thinking about what you might buy, because you've probably missed the first 10% or 20% of the bounce. You need to do it now. Sort out what it is you want to buy and just watch the price action and act accordingly. So the bottom line is, be guided by the charts and not by what you think. and what you think is very influenced by what media you consume. So try and ignore the headlines, just watch the charts, because in 2020 that was absolutely the best road to take. There's no question about it. And if you used a tool like the accumulation distribution line, it became very obvious which stocks were being consistently sold off intraday and which stocks were actually being accumulated. And that was an incredibly good guide to the stocks that were about to do amazingly well. So with those initial comments, let's have a look at what the markets actually did. The S&P fell 2.2% for the week. It's only one day. It was a Thanksgiving holiday shortened session. There was lower liquidity. You know, it's an unreliable data point is all I can say. Now, I'm not suggesting that there's not going to be more selling next week. I really have no idea, and there could well be more selling next week. But it would pay just at this stage, until we see what Monday looks like, not to overreact to this. However, there are some sectors that are more at risk than others. And I did note on Friday that numerous stocks did fare pretty well. They didn't go down very much. They closed well off their lows. Some of them finished lower, but actually finished on the high of the session. And the volumes were pretty small. So, it wasn't a disaster. And I looked through probably 200 stock charts in America, and there were quite a few that looked very ugly, but there were a lot that looked just absolutely normal. So let's see what Monday brings. And there was definitely some evidence of rotation to growth stocks, again, as we saw in March 2020. After all the heavy panic selling took place, there was an intraday accumulation into growth stocks that then turned into an absolute avalanche of buying pressure that pushed growth stocks back up again. And growth stocks did incredibly well from March through to November. When the vaccines came out, the pendulum swung back and people started moving back into so-called value stocks. But growth stocks did incredibly well in that 6 or 8 months leading into the end of the year. Now, the US dollar was steady at 96.09, but it did almost get to 97. So I was quite surprised at how much the US dollar sold off on Friday, and it has me wondering where the money went, because the Australian dollar went down as well. So that's a real head scratcher for me. The 10-year yield fell, obviously, with now, the knee-jerk reaction was lower expectation for interest rate rises. So therefore the yield fell from about 1.65 to 1.47, which is a fairly significant move. And the VIX, which had been tracking up from around 16 to just under 20, absolutely exploded on Friday and almost touched 30. So let's look at some charts. There's the S&P. You can see quite a sharp sell-off. It's a large candle. We hadn't seen a candle like that since one time in September. And then you've really got to go back to May. And really that's about it. There's been very precious few of those sorts of candles. But as I said, it was Friday, shortened day, low liquidity. This could be misleading at this stage. But one thing that has happened is we've broken the 20-day moving average. So the market will be looking for support around the 50-day moving average and somewhere around this peak. So around 45.40 would be an area of support to keep an eye on. Not that any of us, I guess, trade the S&P, but at least it does influence sentiment. Now, if we look at some of the important spread charts, this is the Russell 1000 growth, so large cap growth versus large cap value. You can see we were getting a bit of a pullback, so we'd reached a double top. We were getting a bit of a pullback earlier in the week, so a bit of a rotation into value. But then you can see on Friday we kicked up. So growth was actually favouring value stocks. And that was because, a lot of big energy names, a lot of airlines, a lot of hotel groups got sold very heavily. And if we look at consumer discretionary versus staples, you'd have to expect that there would be a rotation to consumer staples on Friday. And, it had been going during the week, and it did increase a little bit on Friday as well. Now, if you look at the NASDAQ, encouragingly, it didn't do any worse. In fact, it probably did slightly better than the S&P did on Friday. So again, just underscoring that growth stocks were not getting smashed in this particular situation. There's the Russell 2000 for small caps. We had a breakout. It's turned out to be a false breakout. We're now back in the range. You can see very heavy volume in the small caps, but they did close well off their lows. So that is interesting. That this was not as emphatic in a shortened session. You would expect that if the market sentiment had really turned bad, that this would have closed on its lows on such big volume. But it actually found some support. And if we look at the mid caps, so we'll look at MDY, which is the 400, the ETF for the 400 mid caps, and you can see again we had a false breakout. We haven't come back into the range yet, but similar looking sort of candle on support, big volume. So we really need to see what the follow through is on this. Now, if we look at the currencies, there's the US dollar. It was very, very strongly rising until Friday came around, and it pulled back quite sharply. But you have to say it's still clearly an uptrend, and that left the Aussie dollar right down on key support, and you can see it gapped down quite strongly. So we're right on key support now at about 70.7. And there's another support level at about 69.7, but then after that it gets a bit ugly. You've got to go all the way down to 60. So we'll see how the Australian dollar plays out. So 70.74 was the final. Our index fell 1.5% for the week. All of that was on Friday, and all sectors were sharply lower. But that was better than what the American market did. So Japan, Hong Kong, they were all down in excess of 2-3% on Friday. And the US were down, the indices were down by in excess of 2%. So our index is likely to play a bit of catch up on Monday, you would have to think, given there was such strong follow through in the US and in Europe. So let's just look at the ASX 200. And there you can see quite sharp selling. But look, our index has not done anything since June, really. We've had 5 months of just nothing, 6 months of absolutely nothing at the index level. And if we look at some of the sectors, there's energy, really got hit very hard on Friday. Finance also hit hard, as you would expect. And that's, again, what happened in March of last year. Healthcare holding up better than some of the other sectors, and materials also didn't do too badly on Friday as well. And when we get to the other commodities section, you'll see why. And I would expect that we may not see too bad a performance from the materials sector on Monday. Turning now to precious metals, gold fell $81 for the week, but that had all happened before Friday. That happened in the days before that. So we're back down under 1,800, and that was largely because of the inflation data, and the higher US dollar was both pressuring gold lower. Friday, interestingly, failed to ignite the price. It's hard to see with so much debt around, so much stimulus, inflation rising. It's hard to not see a better environment for gold, and yet gold doesn't seem to be able to sustain a rally. And Friday, you would have thought, would have been a pretty ideal time for gold to rally, but just couldn't do it. And if you look at precious metal stocks, naturally they were down because the stock market was being sold. So that, that doesn't protect gold stocks. But on a relative basis, they didn't do too badly. They were certainly one of the least worst performers on Friday. They were lower, but not as low as many other areas. But it's still really hard when you look at the failure to response from gold and gold stocks to what is a pretty conducive environment. It's still hard to get excited about precious metals, I've got to say. So let's take a quick look at those charts. Here's Bitcoin. Bitcoin got hit as well, so pretty much anything speculative got hit on Friday. We had a breakout above 64,000, but we finished the week down at basically 54,000, and we may even come down and test this 200-day moving average yet. So Bitcoin in a bit of a limbo. There is gold on the daily basis. You can see the big sell-off occurred on Monday, more selling on Tuesday, and then we did trade up at one stage on Friday, but then it lost it again. So not very encouraging signs from gold. And there it is on the weekly. So now we're basically back into this declining downtrending channel again, which is pretty disappointing if you're a gold bug. Silver, similarly, can't really get any lift going there either. Turning to other commodities, copper was steady at $4.33. Nickel, which had soared earlier in the week, got up to, I think, around 9.40, 9.45, actually came back to 9.15, but net was still up quite nicely for the week. Now, crude oil got absolutely murdered, it was trading above 80, came down to 69.5, and it just amplifies Biden's stupidity and others in the West releasing oil from strategic reserves to try and manage the oil price. I mean, it just leaves me speechless. China must be sitting back there giggling that the West is so stupid as to be trying to manage the oil price for political reasons from strategic reserves. I mean, strategic reserves are there for, it's the reserve of last resort. It's there for emergency use. And when you look at it, what's causing the high oil price? And the oil price, I'm now comfortable saying that the oil price is probably going to go higher from here when this little episode washes through, because we've got chronic underinvestment that's going to continue. There's no way that there's going to be significant investment in the production of oil for obvious reasons. So that chronic underinvestment has dropped off far too quickly for the demand situation. And so the price of oil is going to be higher, I believe, in the future. And so to release oil from strategic reserves, and the amount that they released was the equivalent of 3 days of US consumption. I mean, what is the point? It's just political grandstanding. And as I said, China must be giggling over some of the stupid things that get done in the West in the interest of public opinion. It's really quite extraordinary. There's the copper chart. You can see it didn't really change very much on the week, despite the fact that the US dollar had gone up in the early part of the week and then obviously came back down. It didn't seem to really affect copper much at all. There's the nickel price. You can just see how nickel came back quite sharply. We'd got up to a double top there above $9.50 earlier in the week. And if we look at a 30-day nickel chart, you can see it more clearly. So we went very quickly from around $9 around the 19th, 20th of November, hit 955 before finishing back down at 919 on nickel. So to wrap things up, the best advice that I can provide is really big picture stuff, because everyone is so different in terms of how they should manage their financial affairs. But I think these sort of things should stand you in good stead at times like this. Just deal with the facts, keep the emotion out of it. There'll be some sensational headlines. The media absolutely loves this stuff. It's another great, shiny, new, bad news story. The media is going to be all over it. So just try and ignore that and just deal with the facts. It's really important to know what your exit signal looks like. If you don't know what your exit signal looks like, then you better hook yourself up with someone pretty quickly to establish what that is, because otherwise you're just making decisions on emotions and not on any sort of consistent game plan. You need to be decisive. Don't sit back and wait and see, what happens and then just, do it by gut feel as it unfolds. You'll end up making a series of disastrous decisions. And be alert to buy your targets. So first of all, you need to know what your targets are, and then you need to be alert to be prepared to pull the trigger. And if your nerves get a bit stretched in coming weeks, then just go back and look at the charts of March, April 2020. Look at the different sectors, look at different stocks, just observe how they behaved. You don't need to do anything wonderfully creative here. The market's probably going to play out in a very similar fashion because human nature is very repeatable. So understand what you want to buy. Look at how those prices responded back in March 2020 and just look for similar signs again. Portfolio analyst last week, I had a break. We have 4 breaks a year. That was one of them. This week is obviously going to be very full on. Lots to talk about. There'll be a very detailed analysis of what sectors and what stocks should perform best. So that's coming this week in Portfolio Analyst. Now, there are also some new additional services for existing members. And the thrust behind that is to target even better results in 2022, but not by picking better stocks, because that's only a minor part of it. It's through sharper decision making, better discipline, more clarity around what you're doing. They're all the things that really make the difference in your results. It's not a better recommendation. If you're one of these people that's out there, hunting around for the best tipster you can find, then you are absolutely on the wrong track. It's it's about having good, solid recommendations, but it's everything else that goes around that. And so I'm going to be introducing things that are targeted at helping members get even better results from the resources that they've got. There'll be a couple of parts to that. There'll be a monthly analysis video, which I haven't done before, and I'll be looking at what worked well, what didn't work well, and why, and what could have been done better. So let's continually learn from what we do in the market, and continually evolve our game plan and our level of discipline. There'll also be a new expanded trading plan template, which I think will be very helpful for a lot of people as well. So those things are all coming in the next week or two. If you need to find out more, there's more information on the website, and there's my email address for anyone that wants to contact me. And look, I'm sure this is going to be a fascinating week coming up. I'm obviously going to be all over it, and I'll be back with you next Sunday to report how it plays out. I'll be back with you then. Cheers.